Verizon stock offers passive income investors a dividend yield of 6%, and now with the Federal Reserve starting to cut interest rates, finding yield will become more challenging. Understandably, investors are looking to Verizon as a source of passive income. That said, when you're investing in dividend stocks, I consider more than just the dividend yield. I look at the factors that could influence the stock price and the factors that could cause a company to pause or cut the dividend payment like Intel recently did. So let me walk you through an evaluation of Verizon stock and answer if it makes an excellent investment for passive income investors. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So as I mentioned in the introduction of the video, Verizon Communications offers investors a dividend yield of 6%. Now, it used to offer a dividend yield closer to 8%, but the dividend yield has dropped as a result of an increasing stock price. The company operates in a stagnant industry with limited growth opportunities, and so its dividend yield could be under pressure because of the limited growth. Thankfully, Verizon's business generates strong operating profit margins at 21.79% in the most recent trailing 12-month period. And see, it's turned around after a slide since 2022 when its operating profit margin started declining. One of the reasons Verizon's operating profit margins are declining is people have not been upgrading their smartphones on the usual schedule. They've been holding on to them a little bit longer. And remember, many smartphones were purchased in 2020 and 2021 when consumers were more flush with cash and they had limited areas where they could spend that money. And so there's been a gap between those investments in new smartphones. Now, Apple recently introduced its latest smartphone, the Apple iPhone 16, and it's come out to questionable, unenthusiastic response from the public. Rumors are that the orders are not going as well as anticipated. Still, Apple will be introducing Apple Intelligence, which is going to come out later, and that could spur an upgrade cycle for consumers that were waiting to upgrade those phones they purchased in 2020 and 2021. Still, Verizon's operating profit margin doesn't have much room to go higher, maybe a couple of 100 basis points plus or minus. And the prospects for increasing margins are limited for Verizon. Similar story with its cash flow from operations at a trailing 12-month 26.83%. Verizon's business model is heavy with capital investment to build out the infrastructure for the 5G networks, etc. And then incrementally, each sale leads to significant improvements on the bottom line and cash flow, because it's already spent the cash to build out that network. And so each new customer just brings in more profitability to Verizon. The big risk is that when that next cycle comes, will Verizon be able to maintain the level of market share it's maintaining, right? There is limited upside, but there is a lot of downside because Verizon could lose market share to AT&T, T-Mobile, and others, and perhaps some disruptive technology that comes out of nowhere and takes away Verizon market share. Perhaps that's why the investors, the analysts on Wall Street that are following Verizon stock, they don't expect much from this company over the next 5 years. The earnings per share growth rate expected over the next 5 years for Verizon is less than 1%. Less than 1%. This is about as close as you can get to growing earnings per share without going backwards. And in fact, in the past 5 years, Verizon's earnings per share were negative 0.86%. So small margins of fluctuation for Verizon, limited growth opportunities ahead. Now, I mentioned Verizon's business model is spending heavily in capital investments and building out the network to offer this service to customers, but the returns on that capital have not been great. In fact, in the last 5 years, they've been very bad. 4.56% return on invested capital is less than Verizon's cost of capital. Verizon, to get that money to invest in this infrastructure, has to pay a higher percent than it's earning on that invested capital. And so this is not a good relationship. This is not a good proportion to have as a business, especially as a business that needs so much capital investment. This might be okay if your business doesn't require very much capital, but Verizon's business requires massive amounts of capital, maybe some of the most that you'll see in any business category, the billions of dollars it needs to invest in the network. And so not very good here for Verizon. And then to make matters worse, to build out that network, Verizon has borrowed heavily. It has net long-term debt. This is long-term debt minus cash. So net long-term debt of $147 billion. It's one of the most indebted companies I follow. I don't think any company I follow is more indebted than Verizon. Maybe AT&T, maybe Ford, maybe another car company, but that's close. That's cutting it close. It's one of the most indebted companies in the world. And so when you have this amount of debt, it makes the business that much more risky. Any kind of disruption to its cash flows multiplies in downside, and any kind of disruption in its cash flow, Verizon will be quick to pause that dividend to conserve cash to make sure it can make the debt payments. Debt payments are a priority over dividend payments for most corporations, and I don't think Verizon will be any different. So there's a huge underlying risk here. Right now, it's okay because Verizon generates so much cash flow that it can service this debt without a problem. It's if there's any disruption to its cash flow where this will become a major problem. And finally, let's look at valuation. And Verizon stock has become more expensive in the last year. It was trading at a forward price to earnings ratio of below 7 around October of 2023. But that valuation has increased closer to double digits. It's now trading at a forward price to earnings closer to 10 at 9.456. Now, I've had Verizon stock rated as a hold, and I last updated this recommendation on April 23rd. And for passive income investors looking to generate dividend yield, looking to generate passive income, I think there are better options available. For one, just the plain vanilla 20 or 30-year government bond will give you a passive income yield of over 4%. I think that's a better choice than Verizon stock. I think that yield, even though it's lower than the 6%, that yield is more sustainable than the yield from Verizon. And there are many other dividend stocks that I like better than Verizon. And so right now, I'm keeping Verizon stock rated as a hold. I would not be buying this stock at current valuations. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.